dun, 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 dun. All right. Hello, my name is Charles Lincoln. I'm going to be doing a presentation on BEPS as a sponge tax. Will U.S. taxable bases be lost to BEPS? Presentation by Charles Edward Andrew Lincoln IV, based off an article of the same name as above by David Aronwick. First of all, we'd just like to start off that the U.S. has sought to minimize erosion of its taxable base by U.S. multinationals. This is a goal of BEPS. And here we have our seminal three players from the United States: U.S. Tax Court, IRS, Treasury. Then we're going on to the OECD and BEPS. There's the logo of the OECD and a map of G20 countries. This article talks about how it's negatively going to affect the U.S., and the first comment that it actually brings up is that the U.S. Department has primarily focused on stripping the U.S. of its taxable base. Here I have a photo of the U.S. Treasury founded in 1879 by Alexander Hamilton, one of the framing fathers of the United States and the United States Constitution, who argued for a strong central government and for a strong financial section. Overall, good things, but the U.S. Treasury Department has focused primarily on stripping U.S. of tax bases by U.S. multinationals. This is also a goal of BEPS. Foreign countries gain the tax and the U.S. does not. Basically, I'm summarizing this key section of the article. My summary is the U.S. Treasury has been negotiating with the OECD without congressional input. We have to remember that Congress has the power to rewrite the laws. This was mentioned in the article. Another key issue that's going on right now is that foreign countries could gain the tax, and it could negatively affect the U.S. by shifting additional tax revenue outside. So the article asks us to take a leap of faith and to apply suspend international tax for just a moment to apply an analogy. The death and estate tax is a tax that is imposed by various states. And what the conclusion of this little analogy will be is, as the death and estate tax has incentivized states to maximize the amount that they could tax from foreign countries, maximize the amount that they could tax according to federal limits. Foreign countries will be incentivized to tax the maximum amount that the U.S. would subsidize. The death tax explanation was imposed by the death tax, just by a short explanation, is found in Section 2001 of the Internal Revenue Code, and basically states that if the death tax is imposed by a state or the District of Columbia in respect to inheritance, legacy, or descent and distribution of property, the general excise will be credited according to federal limits, and the rates are bracketed in Section 2011B for the amount of credit available. We don't need to go into details, but basically you need to understand that if a tax is imposed by a state, that is a state or the District of Columbia, then the person, or the people receiving the income tax, or the person filing taxes, shall be able to credit those taxes paid on the state level to the federal level up to these limits. Okay, so there's a limitation and it's not to exceed this amount. And if it were to exceed that amount, there'd probably be ruckus and all sorts of things and incentivization. So basically what this says, as we go back to that conclusion that we said, as the states are allowed to tax this maximum amount, all the states tax to this amount. And the government allows for the states to tax to this amount, and it's credited on the federal level. Analogously, if other countries, other states of the world are allowed to tax this amount, they're going to gain that maximum amount of revenue, and they're going to tax that amount. This will lead to higher taxation for U.S. companies in other jurisdictions. Not a higher tax, just higher tax in other jurisdictions, and less tax in the United States. So, how does this affect the IRS and U.S. tax credit? If foreign countries follow the OECD project, then U.S. multinationals will pay a greater amount of tax and claim more foreign tax credit. Thus, U.S. tax revenue could be eroded. with a huge increase to foreign tax credit. The issue magnified. Suppose a foreign government imposes a 15% tax rate. Because there would be no negative effect of the business investment by U.S. companies, the company would face taxes on the earnings of the foreign subsidiaries 15%, regardless where collected. So, how does this affect the U.S. again? Again, foreign countries gain the U.S. tax. Another issue that the article brings up is the hybrid issues, that the U.S. companies are using hybrid issues to create stateless income. We're familiar with that in regards to the Apple case. So just to confirm, it's about there's a concern about action 2 because it could also lead to the erosion of debt. It's not just taxing in other jurisdictions. It's this source 2. This is a picture. All these pictures are from Wikipedia. How does this affect the U.S.? It could all, and like we said, it's shifting taxes out, and excess returns proposals will cause Subpart F, foreign-controlled CFC legislation in the United States, to be separate income for determining payers' foreign tax credit. It will raise foreign taxes and penalize U.S. multinationals, thereby allowing U.S. multinationals to avoid the penalty. My counter arguments for thoughts for discussion, the U.S. Treasury is really negotiating the arm of the executive branch in regards to taxation with entities such as the UN. Executive agencies are given this authority by the Constitution based off of Article 3 of the U.S. Constitution. And just to confirm, the limitation is only the Chevron doctrine that was enunciated by the U.S. Supreme Court in 1984. Here's my summary of it on the left. My summary of my summary is that Congress has Congress acted? If yes, if no. Has the agency acted? Has it acted within the penumbra of Congress? If Congress hasn't acted, that means the agency is allowed to act. And if Congress has acted, is the agency acting within the letter of the law? And if the answer is no, then it's not allowed. But if it's yes, then it is allowed. So, if Congress was, but my counter to that counter argument is that Congress was never informed and the statutes are not applicable because they were never drafted to be in conjunction with the OECD. Perhaps U.S. multinationals should be paying taxes abroad. I'm not saying that, and neither is the author, that the multinationals should not be paying taxes abroad. What I am saying is that support for this is that source taxation should be where the activity is saying. But given that support, I also would like to say that Peter Harris, who lectured to us, said that multinationals often don't mind having to deal with double taxation as long as it's certain what the numbers will be. Overall, the author does not oppose BEPS outright and sees it as valuable, but recognizes the need to keep U.S. tax revenue coming in. So how do you all think that the U.S. should solve this solution by funding source taxation? The amount that they could tax.